What if I told you the most profitable move a company could make this year wasn't launching some groundbreaking new product?
Right, but actually just, walking away from a massive mega merger.
Exactly. I mean, today we are looking at how an entertainment giant literally pocketed $2.8 billion for a deal they didn't even close.
It's one of the most fascinating strategic flexes we've seen in recent corporate history, honestly.
Welcome to the deep dive.
Glad to be here.
Today we have a really highly revealing stack of sources to unpack for you. We are pulling directly from Netflix's Q1 2026 shareholder letter.
Yeah, and the Q1 earnings call transcript, too.
Right. Along with some very detailed internal financial analyst notes that give us the real context.
Because, our mission today is to essentially reverse engineer the company's entire blueprint for 2026.
Which goes way beyond just like what shows are coming out next month.
Oh, absolutely. We are dissecting their three-pronged growth strategy. We're going to analyze the mechanics of that collapsed Warner Bros. Acquisition.
And we really want to tear into the raw financial metrics because those top-line numbers on a press release, they can often mask the actual health of a business.
Yeah, you really have to look under the hood.
Right. So to figure out if this streaming behemoth is truly a cash printing machine or just writing this one-time financial windfall, we really have to start at the foundation.
Which is the core product.
Exactly. Before anyone pays for a subscription or, an advertiser buys a spot, someone actually has to sit down and watch the screen.
And that brings us to the first pillar of their 2026 growth strategy, which is delivering more entertainment value.
Which sounds a bit like corporate jargon at first.
It does, yeah. But they measure this through what they call their primary internal quality metric. And that metric just hit an all-time high in Q1.
So what does that actually mean on a practical level?
Well, the underlying philosophy here is fundamentally shifted. They no longer treat all watch hours as equal.
Okay, let's unpack this for a second because I found that detail in the shareholder letter totally fascinating. Like if I leave a sitcom running for 5 hours while I vacuum the house, that technically counts as volume.
Sure, it's hours on the platform.
But they are arguing that background noise isn't what drives their business anymore.
No, not at all. They are hyper-focused on winning what they call moments of truth.
A moment of truth, what does that look like?
So a moment of truth is an active, resonant engagement. It is the exact moment a viewer finishes an episode and actively navigates to watch another.
Oh, okay.
Or even better, when a show sparks so much cultural momentum that it literally leaves the platform and enters the real world.
Right. The sources highlighted the latest season of Bridgerton for this.
Yeah, exactly. I mean, it drove 94 million views, which is huge, sure.
But the internal notes emphasized the real-life fan events it sparked, right, in over 20 cities.
Yes, because that level of cultural saturation is what actually drives organic new signups.
I noticed they're also pushing really aggressively into completely new categories to try and manufacture those moments on a wider scale.
Right, expanding the footprint.
Yeah, and the biggest pivot seems to be live sports, which honestly feels like a stark departure from the whole binge-watching model that made them famous in the first place.
And it is a massive shift.
So is the payoff actually matching the insane investment required to secure those live broadcasting rights?
Well, the Q1 data proved it's highly calculated. I mean, look at their streaming of the World Baseball Classic in Japan.
Oh, wow. Yeah.
They pulled in 31.4 million concurrent viewers. It actually became their most watched program ever in that country.
That is just a staggering portion of the population tuning in at the exact same time.
And the business impact is the real story here. That single live broadcast sparked the largest single sign-up day in the entire history of Netflix Japan.
Wait, really? Just from one game?
Just from one event. It single-handedly made the entire Asia-Pacific region their strongest growth market for the quarter.
That makes sense. I mean, a standard 10-episode scripted drama simply cannot drive a localized, explosive spike like a live cultural event can.
Exactly. And they have the heavyweight fight between Tyson Fury and Anthony Joshua coming up in the UK next, using the exact same playbook.
So they are absolutely dominating weekend viewing and massive evening events. But looking through the sources, they're also moving way outside the living room television.
Oh, completely.
They're spending heavily on video podcasts, bringing in massive names like Bill Simmons and Brian Williams.
Yeah, the audio-video hybrid space.
And they just launched a standalone kids gaming app called Nflx Playground, which is interesting because it has absolutely zero ads and no in-app purchases.
Which is incredibly rare for mobile games right now. But podcasts and mobile games solve a historical blind spot for the company.
How so?
Because video podcasts over-index heavily on daytime viewing and mobile devices.
Ah,
That's the morning commute, the desk lunch, the gym session, time they weren't capturing before.
but I mean, are they risking diluting their core brand? I traditionally think of Netflix as a premium, like, nighttime theater.
Sure. The default evening activity.
Yeah, but now it feels like they want to be your daytime radio station and your kid's afternoon babysitter. Are they trying to become the everything app for entertainment? And does that weaken what makes them special?
Well, what's fascinating here is that analysts frame it less as changing their identity and more as capturing incremental engagement.
Incremental engagement.
Yeah, they want to monetize the hours of the day they previously ceded entirely to platforms like Spotify or YouTube.
Oh, I see.
And that kids' gaming app is a perfect example of how this works mechanically for retention.
Because it's completely free of ads.
Right, and it's tied to their IP. They take a popular animated show on their platform and turn it into an interactive game on Playground.
So a kid watches the show on the living room TV.
Exactly, and then plays the game on an iPad in the backseat of the car. It weaves the intellectual property through multiple formats.
Creating a cross-medium synergy.
Yeah.
If your kid is depthly hooked on both the show and the game, I mean, canceling that service becomes a much harder conversation for the parents.
It deepens the whole family's reliance on the ecosystem. You use an ad-free loss leader app to essentially lock in a monthly subscription that covers the whole household.
Okay, so capturing attention in the morning commute, the afternoon car ride, and the evening living room is an incredible feat.
Definitely.
But attention alone doesn't pay for billion-dollar content budgets or, giant server farms.
No, you have to monetize it.
Right. So how are they taking this expanded engagement and actually turning it into real revenue?
Well, this brings us directly to the second and third pillars of their 2026 growth strategy, which is leveraging technology and aggressively improving monetization.
And the engine pulling this forward is their advertising tier.
Yes, the ad tier is completely transforming their financials.
The ad-supported tier is priced at $8.99 in the US right now. And the numbers in the earnings call are wild.
They really are.
In Q1, that specific tier accounted for over 60% of all signups in the countries where it's available.
Which is a massive adoption rate.
It is. They now have over 4,000 advertisers on the platform, which is a 70% increase. And they're on track to hit $3 billion in ad revenue in 2026.
Which is a massive pivot for a company that, built its entire identity on being adamantly ad-free.
Yeah, remember when they said they would never run ads?
Exactly. And the real trick here is that they are managing this pivot while simultaneously executing subscription price hikes in major markets like the US and Spain.
Here's where it gets really interesting to me. You might assume that pushing an ad tier would cannibalize their premium subscribers.
Or that hiking prices would push frustrated users straight to the cancellation button.
Exactly. But the data shows something completely counterintuitive. Their retention rates actually improved year over year.
Yeah, they went up.
So for the listener trying to figure out their own budget, does this mean the era of cheap ad-free streaming is definitively dead?
If we connect this to the bigger picture, Netflix would argue they are simply offering a wider spectrum of choice. And they're creating a brilliant, virtuous cycle in the process.
How does that cycle work?
They basically tell the consumer, look, you can pay a premium price to protect your pristine ad-free experience.
Right.
Or you can pay less, but your attention fuels our $3 billion ad machine.
Ah, so either way, the average revenue per user goes up for them.
Exactly. They win either way.
Yeah.
And to widen the profit margins on that ad revenue, they are heavily pivoting to programmatic advertising.
Okay, let's unpack programmatic advertising, because that term gets thrown around a lot in tech circles. But what does that actually look like for Netflix's bottom line?
Well, instead of relying on a massive team of human salespeople, negotiating individual ad spots with brands over expensive lunches.
Like the old Mad Men model.
Right, exactly like that. Programmatic advertising automates the entire process using algorithms.
So brands just bid on the space.
Yeah, brands bid on the ad inventory in real-time auctions. And this happens in milliseconds, right before your video even loads.
Wow. And the sources said over 50% of Netflix's non-live ad business is now programmatic.
Which is incredible scale. The mechanism here is that they can serve millions of highly targeted ads globally without carrying the massive overhead of a traditional broadcast sales department.
So the technology just strips out the human friction.
Exactly, completely lowering the cost of generating that revenue.
And it seems like they are applying a very similar tech-driven, cost-cutting mentality to the actual creation of the shows and movies, too.
Yes, the production side.
The sources highlight their recent acquisition of a company called Interpositive. This is a generative AI filmmaking technology company founded by Ben Affleck.
Right, and content creation remains Netflix's single largest expense by far.
Obviously. And generative AI in Hollywood is a highly, highly charged topic right now.
Oh, extremely. But Interpositive is focused more on the mechanical, logistical side of filmmaking.
Like what?
We're talking about pre-visualization tools. Directors can use AI to map out complex lighting, camera angles, and set designs digitally before anyone even builds a physical stage.
That makes a lot of sense.
Or visual effects prep, automating the really tedious masking and tracking work that usually takes post-production teams hundreds of hours to do manually.
Okay, so it's not about an AI writing a script or, replacing a lead actor.
Well, not at all.
It's about an AI ensuring you don't need a 100-person crew standing around on a soundstage for 12 hours while the director tries to figure out a tricky camera angle.
Exactly. And the savings there are astronomical when a major film set costs hundreds of thousands of dollars a day just to run.
Right.
Faster, more efficient production schedules mean lower baseline costs, which translates directly to wider profit margins on every single piece of content they release.
So with programmatic ads stripping out sales overhead and AI cutting physical production costs, the profit margins are widening dramatically.
They are swimming in capital.
Which leaves the executive team with a very specific, almost enviable problem.
Yeah.
What do you do with a massive growing pile of cash?
And this leads perfectly into the elephant in the room.
The collapsed Warner Bros. Mega deal.
Right. The timeline on this is just fascinating. Netflix was deep in negotiations to acquire Warner Bros. The entire industry was bracing for this tectonic shift in the media landscape.
Yeah, it would have changed everything.
And then suddenly, Netflix just walked away. Co-CEO Ted Sarandos bluntly stated on the earnings call that the studio was a, quote, nice to have, not a need to have.
I mean, they realized the cost of the deal, integrating the massive physical infrastructure and the looming regulatory headaches, all of it just grew well beyond the net value to their actual streaming business.
It wasn't worth the distraction.
But the shocking part isn't just that they walked. It's that because of how the deal was structured, Netflix received a $2.8 billion termination fee.
Which is wild. That fee alone is bigger than the entire market cap of many mid-sized tech companies.
I mean, it's like walking away from a bidding war on a mansion, but the seller pays you $2.8 billion just for showing up to the open house.
That's exactly what it feels like.
How does a company even negotiate getting paid billions for a deal they chose not to close? Was this essentially Netflix buying a massive insurance policy on the negotiation?
Think of it kind of like an earnest money deposit in a massive real estate transaction, but working in reverse.
Working in reverse.
Yeah, Warner Bros. Wanted this merger to happen so badly that they agreed to penalize themselves if the deal encountered excessive regulatory hurdles.
Right.
Or if the structural costs skyrocketed during due diligence, which ultimately forced Netflix to bail.
Wow.
It is a massive risk mitigation mechanism. Netflix protected their downside so thoroughly that the failure of the deal actually became a highly profitable quarter.
It completely redefines corporate leverage. But going forward, does an outcome like this signal to the market that Netflix is just done trying to buy legacy studios? Like, are they scared off by the complexity of integrating these massive conglomerates?
It's interesting you ask that because the Analyst notes suggest the exact opposite. Yeah. Historically, Netflix has been characterized as a company of builders, not buyers. They built their own streaming tech, their own global studio infrastructure.
Sure.
But running the gauntlet of the Warner Bros. Acquisition built serious M&A muscle within their executive team.
They learned how to play the game.
Exactly. They proved they can operate at that staggering scale and negotiate incredibly complex downside protections.
Yeah.
The market actually expects them to remain highly opportunistic moving forward, just looking for undervalued assets.
But fiercely disciplined. I mean, in Hollywood and honestly in Silicon Valley too, we see CEOs fall in love with the idea of a legacy-defining mega deal.
The ego takes over.
Exactly. They want the trophy, so they overpay, they ignore the warning signs in due diligence, and they just deal with the financial consequences later.
But Netflix demonstrated they will only pull the trigger if the math makes undeniable sense.
Right.
And because they didn't sink tens of billions into Warner Bros.,
Yeah.
Their capital allocation philosophy just reverted to its standard, highly disciplined cadence.
Which they outlined pretty clearly. First priority is organic reinvestment into their own platform.
Right. Selective M&A is second.
And returning excess cash to shareholders is third. And they didn't waste any time on that third priority, did they?
No, they didn't. Following the collapse of the deal, they instantly fired up their stock buyback program again.
Yeah, in Q1 alone, they repurchased 13.5 million shares for $1.3 billion.
Which is a very mechanical way of increasing shareholder value. By buying up those shares and retiring them, you reduce the total supply of stock on the open market.
So the pie gets smaller.
Right. And that automatically increases the earnings per share for everyone still holding the stock. It basically tells the market, we don't need a legacy studio to grow. The best investment we can make right now is just buying our own company.
Walking away from a bad deal definitely shows discipline, but to know if they actually have the strength to thrive without a massive studio acquisition, we really have to stress test the core business model. So what does this all mean for you, the listener, trying to evaluate this company? We need to look under the hood at the raw financial reality. Because it's easy to sound brilliant on an earnings call when someone hands you a $2.8 billion check.
Anyone would sound brilliant.
Right. But we need to know if the underlying business is truly healthy.
And this is where the internal analyst notes are crucial because the headline numbers require some serious translation.
Okay, let's hear it.
Top-line revenue in Q1 grew 16% to $12.25 billion. Free cash flow, which is the actual cash they have left after paying all operating expenses and capital expenditures, hit a record $5.1 billion for the quarter.
That's huge.
And they even raised their full-year 2026 free cash flow target to $12.5 billion.
So the cash is piling up rapidly. I saw their balance sheet shows they're sitting on $12.26 billion in cash.
Yep.
And total gross debt is $14.36 billion. So if you subtract the cash from the debt, their net debt is incredibly low, just $2.12 billion.
Which, for a company operating globally with massive content commitments, carrying only $2.1 billion in net debt, is almost unheard of. It gives them massive strategic flexibility.
But here is where the metrics get tricky and where I want to push back a little bit.
Okay.
Their return on equity, or ROE, sits at roughly 16.9% for the quarter.
Right.
Now, if I'm looking at this company, trying to figure out if it's a stable long-term play, is that 16.9% real? Or is that number completely artificially inflated by that one-time Warner Bros. Breakup fee?
You hit the nail on the head. This raises a really important question.
Okay.
That 16.9% return on equity and their massive earnings per share of $1.23 for the quarter are absolutely supercharged by the $2.8 billion termination fee.
I knew it.
Yeah. I mean, return on equity measures how much profit a company generates with the money shareholders have invested. So if a massive one-time cash injection drops onto the balance sheet, your ROE looks incredibly...
Excuse the whole picture.
Exactly. If you only look at ROE, you get a totally distorted view of their day-to-day operations because they aren't going to get a multi-billion-dollar breakup fee every 3 months.
So it's basically a sugar rush on the balance sheet.
Yeah, that's exactly what it is.
It's like running a lemonade stand that makes $50 a week, but then your rich uncle gives you $1,000. If someone only looks at your total revenue for that week, they think you are a lemonade genius.
That is a great analogy. And that is exactly why analysts rely heavily on another metric to bypass that sugar rush, which is ROCE, or return on capital employed.
ROCE, how does that work?
Well, ROCE strips away some of the noise. It looks at how efficiently a company uses all its available capital, both debt and equity, to generate core operating profit.
Okay.
It ignores the rich uncle's $1,000
Yeah.
and tells you exactly how profitable the lemonade actually is.
All right.
And Netflix's ROCE sits at a highly efficient 8.1%.
Oh, wow. So ROCE acts almost like a polygraph test for the actual business model.
Exactly. It proves the core engine is working smoothly. When you combine an 8.1% ROCE with a raised free cash flow target of $12.5 billion, the conclusion is pretty clear. Even without the breakup fee, they are definitively a cash-generating machine.
What about the gross debt, though? I mean, $14 billion is still $14 billion. In an environment where the cost of borrowing can fluctuate wildly, does carrying that much gross debt limit their agility?
Well, for that, we have to look at their weighted average cost of capital, or WACC.
Right.
Because their net debt is only $2.1 billion against a total asset base of over $61 billion. They aren't reliant on securing new, expensive debt to fund their daily
It's
operations.
sustaining.
Completely. Their cost of capital is incredibly manageable. They have what analysts call a fortress balance sheet. I mean, if they absolutely had to, they could pay off almost their entire debt load tomorrow with the cash they currently hold.
That's remarkable. So we are looking at a blueprint that is just firing on all cylinders.
Yeah.
They have a three-pronged growth strategy designed to capture every possible hour of your day. From daytime video podcasts to interactive kids games that lock in family retention to massive live cultural events like the World Baseball Classic.
And they are monetizing those hours with ruthless efficiency. They've built a $3 billion programmatic advertising engine that gives users a cheaper entry point while actually boosting average revenue.
While integrating generative AI to suppress physical production costs.
Yep.
And they have the ironclad corporate discipline to walk away from an ego-driven deal like Warner Bros. Just because the math didn't align, securing a $2.8 billion payout for their trouble while keeping their debt highly manageable.
But there is one final forward-looking element from the shareholder letter that changes the entire complexion of this story.
Oh,
And it comes down to leadership. The governance update regarding Reed Hastings is deeply significant.
oh, right. Reed Hastings is the visionary founder who built this company's DNA from the ground up.
Yeah, he championed the famous corporate culture of brainstorm to scale at breakneck speed.
He was such an artful, aggressive leader. And critically, he was a massive champion of the Warner Bros. Deal before it eventually fell apart.
And now he is officially stepping down from the board of directors.
It really is a profound changing of the guard. You are removing the architect of the original disruption.
And with Hastings entirely out of the picture, look at what the company is pivoting toward. Programmatic advertising tiers, live sports broadcasting, cost-cutting production tools.
Highly disciplined, math-first capital allocation.
Exactly.
You have to wonder, as they lean so heavily into these traditional models, will Netflix be able to maintain that unique, risk-taking Silicon Valley DNA that made them a disruptor in the first place?
It is the ultimate innovator's dilemma.
Right. By focusing so heavily on margins and advertising, are they slowly turning into the very legacy media conglomerates they originally set out to destroy?
Once you conquer an industry, how do you govern the peace without becoming the slow-moving empire you overthrew?
That's something for you to mull over until next time. Walking away from a bidding war with billions in your pocket is a masterstroke today, but you still have to figure out what kind of company you want to be tomorrow. Thanks for joining us on this deep dive.